Do you still not know the secrets of the US stock market? History shows that a certain type of stock always explodes in January. Which stocks will it be this year? Hello everyone, this is Michael's Fortune Bread, your US stock market explorer. What is the January effect? From the average monthly returns of major global financial markets, it can be seen that January is the strongest month, with an average return rate of 2.86%, far higher than the remaining 11 months. So, is this the January effect? The January effect is far more than this. Of course, you can directly buy the market index to ride this trend, but this would waste the most valuable opportunity within the January effect. The most powerful and explosive stocks in the January effect are actually a very special category. These stocks always explode in January, and this pattern has continued for nearly 50 years, never changing. Nowadays, various signs indicate that this year's January effect will be very obvious. Even if you don't make money from it, understanding it can help you better understand the stock market's performance. So, what exactly is the January effect? Is it reliable? What are the characteristics of the explosive stocks in the January effect, and which stocks are most likely to explode this January? In this video, I will provide you with all the answers. Why is the overall market performance in January the best of the year? Is this a historical coincidence, or is there a theoretical basis? For this question, many in-depth studies have been conducted within the industry, but there is no conclusive answer so far. However, the January effect does have a theoretical basis. I have read many related papers, and the core reasons can be summarized into these 2 points. The first is due to the capital aspect. The end of the year and the beginning of the new year are often the times when major companies distribute bonuses. Coincidentally, many tax-advantaged accounts increase their limits in January, so many retail investors habitually invest their bonuses and savings into the stock market at this time. Similarly, fund managers also often receive a lot of new funds during this period, and January happens to be when they return from vacation and start planning for the year. Whether it's institutions or retail investors, January is the month when new capital enters the market, most concentratedly, naturally driving the stock market up. The second widely recognized reason is investors' positive sentiment. This might sound a bit vague, but it can be corroborated by the Consumer Confidence Index, which purely reflects emotions. Historically, this index often shows an abnormal increase in January, and January is also when it is highest on average throughout the year. Similarly, this positive consumer sentiment also applies to investments. Every January, investors' emotions are often the most high-spirited, with over 1/3 of Americans making new investment plans at the beginning of the year and actively seeking new investment opportunities. This increases the market's trading momentum, making it easier to push the stock market up. So, given that January has so much upward momentum, does that mean we should blindly buy the market index? It's definitely not that simple. According to Bloomberg's latest research, before 1993, the performance of the US stock market index in January was exceptionally outstanding, with an average return rate of 1.85%, leading all months. This is completely consistent with the stock market performance of all major global economies, as we mentioned at the beginning. However, in the 30 years after 1993, the performance of the US stock market index in January became exceptionally mediocre, with an average of only 0.28%, not even ranking in the top 6 for the year. Clearly, if you blindly invest in the market index to bet on the January effect, the result might not be as good. Some viewers might question, since the January effect is so weak in the US stock market. Index Is there still any point in understanding it now? Of course there is. The underlying logic of the January effect hasn't changed. It still exists in today's US stock market, but now it is positive for some stocks and negative for others. The stocks that truly benefit from the January effect are becoming more concentrated and more hidden. In a paper published in the Journal of Finance, the author created two investment portfolios. The first portfolio is called the loser portfolio, which consists of the 35 worst performing stocks of the previous year from a certain pool of stocks. This portfolio is dynamically adjusted each year to include the 35 worst performing stocks of the previous year. The other portfolio is called the winner portfolio, which consists of the 35 best performing stocks of the previous year from the same pool. This portfolio is also dynamically adjusted each year. The author combined data from 1933 to 1980, nearly 50 years, and produced the average performance of these two portfolios over 36 months. Overall, you can see a counterintuitive phenomenon that the loser portfolio of the previous year generally outperforms the winner portfolio over the next 3 years. But that's not today's focus. The focus is that for the loser portfolio, there is a significant jump every year, which coincidentally happens all in January. At the same time, if you observe the winner portfolio, you don't see this phenomenon at all. In fact, they often show a decline in January. So the January effect does not occur uniformly across all stocks, but is more likely to occur in those that performed poorly in the previous year. I can tell you that not only does this pattern exist, but it has become stronger. Just last month, UBS published a report indicating that if you look at the S&P 500 stocks that fell more than 10% in the past 35 years, they averaged a 2.3% return in the following January, significantly outperforming the market's 0.5% during the same period. Wolf Research's recent study also found that if you look at the 100 worst performing stocks each year from 2006 to 2024, they performed well from late December to the end of January, averaging a 2.5% outperformance over the market. There are many similar studies, but I won't list them all. The conclusion is very clear. The January effect still exists today and is generally found in those stocks that performed poorly in the previous year. Why is it that only losers experience the January effect? One reason is rebalancing. At the beginning of each year, many large funds need to sell off stocks that rose too much last year to prevent them from having too high a proportion in their portfolio. These funds are then reinvested into stocks that did not perform well. This operation is called rebalancing. Over the years, with more passive funds, the power of rebalancing has become stronger, further amplifying the January effect on losers. The second reason is related to the trading habits of fund managers. Most funds in the US need to prepare an annual report for their clients, and the general deadline is the end of each year. To polish their annual reports, some fund managers like to sell off their loser positions at the end of the year, so these positions do not appear in their reports. In January of the following year, they buy back the stocks to continue their previous investment plans. However, these two reasons are not the most important. The most significant reason is related to taxes. All other reasons, whether related to sentiment or capital, are ultimately unstable. If you rely on these factors for investment, it will not work. In 2002, a paper by Starks and others titled Tax Loss Selling and the January Effect specifically studied the relationship between taxes and the January effect. In the paper, the authors designed a very clever experiment. To maximize the impact of taxes on returns, they did not test stocks directly, but found a financial product where the tax effect was most significant: municipal bond funds. These funds have certain tax advantages, so their investors are the most sensitive to taxes. From the monthly performance of these funds, it is clear that their average return in January is as high as 2.2%, which is very high for a bond fund and far exceeds the performance of the other 11 months. Obviously, the January effect shows a very clear effect in these funds, indicating that taxes play an important role in the January effect. Over time, this effect has not diminished, but has continued to strengthen. Just this year, in a paper by Carrion and others titled Tax Loss Selling and the January Effect Revisited, they used the same method to re-examine the performance of municipal bond funds after 2000. They found that the actual return rate of these funds in January increased from 2.36% before 2000 to 3.05% after 2000, and even soared to 3.4% after 2007. This shows that the tax effect proven 20 years ago has not diminished but has continued to strengthen. Why do taxes cause the January effect? The answer is simple: to avoid taxes. Investors often sell their losers in the previous year to offset investment gains, and then buy back the losers at the beginning of the next year to redeploy their investments. Some even increase their positions to try to break even sooner. Therefore, in January, a lot of new funds rush into these losing stocks from the previous year, promoting their performance during this period. As for the actual market situation in 2025, we are likely to experience the strongest January effect yet. Why? As mentioned earlier, one reason for the January effect on losers is rebalancing. Data shows that the rebalancing funds in 2025 are likely to be unprecedented. From the past 70 years' performance in the last week of the year, 2024's performance was the worst ever. At the end of 2024, the US stock market experienced 4 consecutive days of decline, the longest year-end decline in 58 years. Interestingly, there was no new negative news during those days, suggesting that this unusual decline may be related to rebalancing. Because many stocks have made money in the past 2 years, and those with large market values, the withdrawal of profitable rebalancing funds is enormous. Once these funds are reinvested into losers, it will significantly boost the performance of these stocks. From a tax perspective, the conclusion is similar. The past 2 years have been great for the US market, and almost all investors who participated in the market made money. This makes tax avoidance a critical consideration for many investors. Therefore, at the end of last year, many people sold their losing stocks to offset taxes. In early 2025, they will likely buy back these stocks, and the reinvestment could bring good returns for these stocks. Alright, so far we know that the effect of the January effect on the overall market is weakening year by year. We also know that the January effect is mainly reflected in the losers of the previous year, and it is expected to be very strong in 2025. Now, the most important question arises: which stocks will benefit the most from the January effect in 2025? I believe everyone has their own opinions about what they consider to be losers. You can make your own choices based on your observations. But I have also selected some current US stocks that are most likely to benefit from the January effect for your reference. The selection process is as follows. First, I chose a stock pool from the S&P 500 and NASDAQ, totaling over 3,600 stocks. The first step in the screening process was to find the loser stocks with the worst performance in 2024. My criteria were stocks that fell at least 15% over the entire year of 2024, significantly underperforming the market by about 40%. These are undoubtedly losers. However, poor performance throughout the year is not enough. The stock should ideally have trapped a lot of people, meaning it should have experienced a significant drop from its high point in 2024. This is necessary to trap those who bought at the high. Hence, my second screening criterion was a drop of more than 30% from the high point in 2024. The third criterion was sufficient trading volume. Only stocks with enough attention and high trading volume can better reflect the January effect. Therefore, the selected stocks had an average daily trading volume of at least 3 million shares. After these three screening criteria, the original 3,600 plus stocks were reduced to just 120 with an entry rate of 3.3%. I won't display all of them here, but I have selected the 10 largest stocks by market value for your reference. They are AMD, Adobe, Pinduoduo, Boeing, Nike, Intel, CVS Health, Schlumberger, Occidental Petroleum, and Ford Motor. Note: this is not a recommendation for these stocks. I haven't analyzed their fundamentals individually today. This selection is purely from the perspective of the January effect. Finally, we must emphasize the risks. First, we need to know that the January effect is ultimately a historical pattern, and patterns always have exceptions. All the conclusions we discussed earlier are more likely to happen based on probabilities and cannot be the sole basis for our investments. Additionally, the January effect is a very short-term trend. According to Wolf Research, they found that stocks that perform well in the January effect often experience some price correction in February and March, and their overall performance for the year is not very good. So overall, if you really want to bet on the January effect, you can only treat it as a speculative operation and an extremely short-term one at that. This means you must control your risks. Don't think that just because Intel has performed poorly recently, you can go all in on Intel because of the January effect. Even for speculation, use small funds to try it out. If you make money, treat it as adding a few dishes to your New Year's dinner. If you lose money, don't hesitate to cut your losses. Remember, these losers underperform for a reason, and holding on to them long-term poses higher risks. Understanding the January effect doesn't necessarily mean you have to use it to make money. I believe the most important role of understanding the January effect is to help us comprehend the logic behind the rises and falls in the US stock market, thereby making more informed investments. For example, if you see a rebound in the stock price of a loser, you can understand that it may not necessarily be a change in fundamentals, but rather the January effect at play. Similarly, if you see good stocks under pressure, it may not necessarily be a problem with the stock itself, but just a short-term impact from rebalancing. Or simply, understanding the January effect can give you more confidence in maintaining your investments. No matter what, I believe today's video will help you start your 2025 investments with more confidence. Alright, that's all for today's video. If you liked my video, don't forget to like, subscribe, and share. Thank you.